And thank you so much for joining us today. I'm Ryan Bouchey, and we will be jumping into our third quarter market and economic update. So today I am joined by my esteemed colleague, Paolo LaPietra. And between the two of us, we'll get into a lot of, I think, interesting topics and discussions. We'll talk about the overall economic overview, where we're at today, what we're seeing, how some of this recent data has changed. We're seeing a little bit of a issue with some of the economic data from payrolls due to the government shutdown. We'll spend a lot of time looking at this current AI build out, right? It's been in the headlines an awful lot. It's having a huge impact both on the markets, on the economy. We'll do a deeper dive into what that all means, and then we'll just take a closer look at how this affects the markets, what our outlook is, what we've been seeing, and where we see this market going from here. So with that, I'm going to turn it over to Paolo to get us into our economic overview.
Thanks, Ryan. So let's kick off the economic overview, and where I always like to start is taking a look at the U.S. labor market. Now, we've looked at a chart like this before. This is showing non-farm payrolls on a month-over-month basis. Those blue bars are showing how many jobs we actually created in any given month. That black line is showing us the 3-month moving averages. And then something new that we added this time is the red dots. Now, the red dots show what the jobs report initially presented when the jobs reports come out. So what traditionally happens is, on any given month, we get our jobs report. It'll say a certain amount of jobs were added into the economy. And then sometime, in the future, there is a revision back. So what we'll see all the way to the right is the initial jobs reports that have come out over the last 6 months. And Ryan pointed out, this is going out until August because we don't have September's jobs report due to the government shutdown. So this is as of August of this year. The initial jobs report showed that we've had some robust jobs growth, but then we see those revisions actually brought it quite down. So over the last 6 months, if we look at that black line, which is all the way to the right of the graph, we've seen a steady decline in labor. Again, nothing super challenging as of right now, but definitely an area of concern for us that we've been watching very closely. Now, on the flip side of things, something that has been really positive has been U.S. consumer spending. And time after time, I've talked about the importance of this because historically speaking, and Ryan's going to show you a few different graphs on this, and how this has changed. But historically speaking, 70% of the U.S.'s GDP is, built upon consumer spending. So if the consumer is out there spending and the consumer is healthy, that's a really positive sign for the economy. So each one of these blue squares here is just showing month over month consumer spending growth. There was one contraction that we saw this year in January. But for the most part, consumer spending has been solid. Now, again, what I really want to focus in on is the most recent consumer spending data. So if we look all the way to the right here, we'll see 3 consecutive months of positive growth in consumer spending. That's an upward trajectory that's showing positive momentum in consumer spending, and that could be a real catalyst for a strong, market outlook going forward. Now, something else I really wanted to highlight is looking at consumer confidence. Now, this chart here goes all the way back to 1970. And this is just showing the, overall consumer confidence that they have, the average US consumer has in the US economy. And what the data is really showing us here is when consumer confidence is at its lowest, this can be a real indicator of positive market returns in the S&P 500 for the 12 months going forward. So if we look at the 9 troughs here, so the 9 bottom points of the US consumer confidence, on average, we're seeing about a 24% rate of return for the next consecutive 12 months for the S&P 500. And if we take a look all the way to the right of this chart here, we're seeing that green dot that's showing September of 2025. We're seeing, something very similar here. We're seeing US consumer confidence, near all-time lows, one of those trough levels. And it's already shown, we have positive S&P 500 returns so far this year. We're floating around 14, 15%. But the data also shows that, this momentum could continue forward. On average, we're seeing about a 24% rate of return. So it's showing that when consumer confidence is low, we still have some room to run from a historical standpoint. Now, this is 4 years in a row, we're still showing the inflation chart. I still say my Hail Marys every night that I don't have to do the next quarter's inflation report, but nonetheless, here we are, where this chart shows what I've shown every time, month over month inflation. It's the same theme, right? We've come steadily down from inflation going back to 2022, and that decline has continued going all the way through 2024 to the early stages of 2025. Now, the challenge here is if we look all the way to the right of this chart, we'll see the last 4 inflation reports. It's still somewhat muted, still somewhat coming in line with expectations. We did have August inflation report coming in at 2.9%. That is exactly what the market expected. The challenge here is 2 things. One, we're still above that Fed target of 2%. So that creates a dilemma for the Fed and Jay Powell specifically. But the other thing here is that positive momentum on the upwards, right? So we're seeing that trajectory over the last 3-4 months of inflation gradually still coming up. And again, that's a challenge for a Fed on what they're going to do with interest rates, especially when we tie in the first slide that I went over, the jobs, right? So if we have material weakness in jobs, which makes the Fed want to cut rates, but we have inflation remaining a little bit sticky and coming up, which makes the Fed want to hold rates. What is the Fed going to do going forward? And that's what we're going to take a look at the next chart. So this is our interest rate outlook. And the way that we take a look at this is looking at the federal funds futures market. So this market just shows the probability of what the market is expecting the Fed to cut, at a certain point. And we have 2 upcoming meetings for the Fed to cut rates. The first meeting is October 29th, and the next meeting is December 10th. So on this chart here, we're seeing no cut, meaning holding rates where they are right now, which is between 400 to 425, so 4.25% to 4%. The market's saying there's pretty much almost no chance that the Fed's going to hold rates at that Fed decision on October 29th. And almost at a 97% chance they're going to cut 25 basis points. So what the market's telling us is there's almost a guaranteed probability that the Fed's going to cut by at least 25 basis points on the October 29th meeting. Now, if we look to the right, we're seeing December 10th. This is the last Fed meeting for any sort of rate decision. And we're seeing almost a 97% chance again for 50 basis points. And what that 50 basis points means is 2 25 basis point cuts for October and December. So the market right now is pretty much expecting with almost 100% certainty that heading into the Q4 and for the remainder of this year, the Fed is going to cut by 50 basis points, one in October 29th and once on December 10th. So what does exactly that mean for bonds? We continue to see a really positive outlook for bonds. I've shown a few different charts that show the risk rewards, but what I really wanted to show on this chart is just, where we are right now and where we've been in the fixed income market. So this chart here shows all those gray bars are the positive return on the US aggregate bond index, which is essentially the S&P 500, but for bonds. And all those red dots show the intra-year volatility that we could see in any given year. So we could see that the bond market could be volatile, just like the stock market. Now, obviously on a much more muted basis, but nonetheless can be a volatile index. But something else that's really important here is if we look on, back in history, we could see in the 90s, after a negative year on the Barclays Aggregate Bond Index, were followed by some really strong returns in the ag. We saw that in the late 90s, early 2000s, in the mid 2010s. And we saw that in 2022, right? We had the Barclays Aggregate Bond Index down 13%. It was down, as high as 17% in that year. And now we're followed by some positive years. We saw a positive year in 2023, 2024, and we're up 6% so far this year. So when you couple the fact that we've had some volatility in 2022, and from a historical standpoint, that shows us some really strong returns going forward. And we couple that with most likely the Fed cutting rates this year by up to 50 basis points, maybe even more, and going into next year, this continues to be a really attractive outlook for bonds and what we're really maximizing within our fixed income sleeve. So in the next part of the presentation, I'm going to pass it back off to Ryan.
Great, thank you, Paolo. So let's talk about it. I mean, we're in the midst of a government shutdown, about 2 weeks into it, hitting all-time highs and leading into what's next from here on out. And it does seem all of a sudden, if you focus on the headlines, right, we're seeing a lot more negative sentiment in the news cycle through the headlines. And here we have a defeated bear saying the end is near. But like I said, we continue to reach these all-time highs. So let's dive into what a lot of these fears are predicated on in this current environment. And right now, not too dissimilar from the late 90s, right? We're talking about kind of this tech bubble fear. And if you look on the right-hand side of this graph, all of a sudden we're seeing a lot more headlines relating to tech and bubbles. But if you go back over the last 3 years, it's almost like an annual rite of passage to kind of see these bubble fears, right? Or headlines and news articles talking about bubbles. They're always out there. So again, we're seeing it in the headlines, but let's dive into really what's going on here and what we should be concerned or maybe optimistic about. The main driver of this fear today seems to be this circularity issue when it comes to AI spending. And I use this chart to start us off because it kind of is what it feels like right now, this power strip plugged into itself. And right, we've had OpenAI coming up with a number of deals. They've invested in Oracle or have future plans to invest in Oracle and build out some of the data centers. You have Oracle investing in NVIDIA, which is going to supply the GPUs and support for these data centers. You have NVIDIA reinvesting into OpenAI. It is this circular loop going on right now. And when you look at what it really looks like, and this is more of a Bloomberg chart to kind of show it, it's not that dissimilar to what we're seeing on the left, right? You have NVIDIA in the center of this all. You have a lot of different, big companies taking part of this spending spree. And, when you take a step back, this circularity can on one hand be a good thing, right? There's companies supporting each other as this growth continues. There's going to be more need for, whether it's the data centers, the GPUs, use of AI with ChatGPT and OpenAI. These companies will all feed amongst each other and help support each other. But with it comes some risk and really in the form of this systemic risk, right? If there's a slowdown in demand, or if maybe the profit isn't there and the funding isn't there for these future projects, all of these companies are kind of relying on one another right now. And if there's signs of weakness in one area, that could spell a bigger issue with that systemic risk to this entire ecosystem. So there is risk out there, but I think we're still kind of in the infancy stages here. What is interesting too, when you think about like a company like OpenAI, right? Their revenue this year is about 13 billion. They're on the hook moving forward for over $1 trillion of spending. So again, it's will they have either the revenue or the financing sources to continue this moving forward? So there is, again, real reason for some of the concern here. And that's where I think a lot of the headlines are stemming from. When we look at what some of this CapEx spending looks like over the last, in particularly the last 3 to 4 years, we're seeing a massive, massive increase with some of these, what they would call hyperscalers. So you have Amazon, Meta, Google, Microsoft, Oracle spending, estimated next year, almost $500 billion in capital expenditures. And most of this is going to this AI build out. So on the one hand, yes, there is substantial increase to spending. The good news is, and especially if you are trying to relate this and tie it back to what we saw in the 90s, these are highly profitable companies. They're pulling a lot of this spending from their cash flow. So instead of maybe sending out dividends or buying back stocks, they're reinvesting into the company. So if they feel as though this reinvestment can help the bottom line down the road, this is where they're allocating those resources. So again, we have very profitable companies rolling this spending out. There is support for it right now. So again, that is a good thing. When we look at the impact of GDP, right? We've talked about this kind of slowing growth environment. And you see this when you look back over the last 3 years or so on a quarterly basis. We're seeing a little bit of a slowing growth economic environment. And right now, this tech CapEx spending is having a huge impact on our GDP. Not quite half of the makeup of it, but it's close to probably a third right now. And so again, you're seeing the economy being supported by this investment and what's being tied into it. When we show a comparison on the next slide to kind of a similar build out with the internet spending of the late 90s, there is some similarities, and we're actually seeing a little bit higher of a percentage to our GDP through this current CapEx AI spending spree. And again, when you do the comparison, we're still probably early on, but you are seeing a ramp up in spending overall. So again, good from one hand in terms of the support of GDP, but maybe again, there are concerns of the concentration of where the spending lies right now. So taking it a step further, right? Talked about AI, seeing the high level spending there, what the impact on GDP. Let's dive in a little bit to, in Paolo brought it up and showed some slides earlier, just kind of the consumer and the strength in the consumer. And right now, this is more of a what we would call a technical chart. And this is a comparison between XLY, which is consumer discretionary sector. Think of companies like Amazon, Home Depot, Tesla, versus consumer staples, XLP. Companies, again, Walmart, Costco, Coca-Cola, maybe areas in the market that, good economy or bad, the spending tends to stay pretty similar, viewed as more probably a defensive sector. As the economy slows down or the market slows down, defensive sectors tend to outperform. And in this current iteration right now for 2025, you're seeing on the right-hand side, tremendous upside right now with consumers discretionary versus staples. That shows more confidence, optimism within the markets, within the economy. You tend to not see that in times of recessions or bear markets. So again, just from a technical standpoint between these two sectors, it's a good sign in terms of what we're seeing right now in the economy and the markets. Talking about earnings guidance. And right now, what we're seeing, this is in the tech sector. Over the last 5 years, we're seeing the highest number of tech companies issuing higher forward guidance. In fact, if you went back over the last 20 years, this is the highest we've seen since 2006. So we're at the highest level of this, these tech companies issuing forward guidance. And why is that a good thing? Well, you think about forward guidance and hitting the quarterly numbers. These companies don't want to overestimate and underdeliver, right? So when you're seeing this positive guidance, again, it doesn't mean everything that the market is going to be fully tied to this, but you are seeing, again, more optimism with these tech companies. Again, these tech companies that are profitable, bringing a lot of positive cash flow through their balance sheets and in their profit and loss statements. And they're seeing some upside potential with regard to the spending and investments that they're making. So again, this is a positive in terms of just where we're at within the market cycle today. And when we look back over history, this goes back over the last 35, 40 years, you do see markets are reflected in earnings. The light blue shade through here are earnings. The navy blue line is where the markets are at on the left-hand side, the right-hand side being, earnings per share. And you're seeing earnings per share really reflecting where the market is today. We're seeing a little bit of a pass through with where the market is. We've talked about it for the last few quarters, really, that, valuations are high today, but as long as earnings continue to maintain and keep up with where the market is at, I think fundamentals can stay where they're at. We're already seeing this week financials, big banks are reporting earnings. We've seen JP Morgan, Bank of America today. Again, they're all having really positive quarterly earnings reports. And so again, we're seeing the bottom line impact through this market cycle. So earnings continue to reflect where we're at with markets. And part of, that headline risk that we see, part of the conversations that we're having with clients is, all-time highs, feeling a little anxious, markets are at all-time highs, you should I be becoming more defensive? Well, as I said in our quarterly letter, it takes all-time highs to reach all-time highs. And yes, maybe in certain market cycles or market environments, an all-time high can be, give us some uneasiness, some fears. But as you see on the right-hand side, this goes back again past 45 years. We're continuing to hit all-time highs in the market. You can see in the middle part of this graph, we did have probably an all-time high, miss for 10, 12 years, really following the tech bubble of the 90s and 2000. But, the last 12, 13 years or so, going back to 2013, we continue to hit all-time highs each and every year. And when you look at even 2025, yes, we've had a number of all-time highs, but it's far from, some of the number of highs that we were seeing in the 90s so far. So again, I just wouldn't be too fearful or too concerned with all-time highs on its own. And we've shared the same sentiment in the past. I do think it's important, again, to remember that it takes all-time highs to meet all new all-time highs. And that's the environment that we're in right now, despite, government shutdown conversations, some of the concerns with the economy, and of course, some of the concerns with AI and the spending spree we're seeing there. Government shutdown, like I said, we're in week 3, and there's not many great charts to use to kind of show what the impact of the shutdown is. I've shared some of the stats over the last few weeks, both with our newsletter, our quarterly market update. Just speaking about over the last 40 years, we've had 20 shutdowns. Generally, the market is flat during times of government shutdowns. Believe it or not, when we've had government shutdowns lasting more than 2 weeks, the market has been up about 2.9% over those shutdowns. So historically speaking, the longer the shutdowns go, it hasn't been a negative or detriment to the overall markets. Right now, I do think, both sides are probably digging in on the issues that are important to them. I don't know if we'll get a resolution anytime soon, but, I did want to sort of just relate, government shutdown, it's highly politicized, right? No matter what side of the aisle you're on. And, when we take a step back, we really don't want some of the headlines or our biases, especially when it comes to politics, to dictate what we're doing in the markets. And right now, we're actually seeing the biggest spread between whether you register as Republicans or Democrats on, sentiment. This chart right here shows percent of share of Democrats and Republicans who expect stocks to go up in the next 6 months. For Republicans, right now it's about 60%. Democrats, only about 10% think stocks are going to go up over the next 6 months. So you're seeing a huge spread there. And if you let that dictate how you invest, and this chart goes back more than 20 years, so you can see, I mean, we certainly flip-flop depending on who's in office at any particular time. No surprise there, right? Politics are a highly emotional topic, I think, for many people. We just don't want those human biases that we all have to dictate our behavior within the markets. I think it's important to take a step back and try to remove those biases when you are making whether investment decisions or thinking about the economy and the markets. I do think there's more of a short-term impact. What we see out of Washington, right? We saw it on Friday into Monday on these new tariffs with China. We saw it at the beginning of the year with regard to the tariff talks and Liberation Day. Obviously, that had a major impact, but it was short-term in nature. It was short-lived. I always say these corporate America, these companies are resilient. They are going to, no matter who's in office, what politics are at play, companies will find a way to do, generally over a long period of time to do well. And I think we have to remember that when we do see, some of these negative headlines or maybe positive, depending on, what news organization you're listening to. But when we're looking at especially political news, we have to keep in mind, again, our biases and what the long-term picture looks like. So with that, just to kind of recap where we're at and how we're thinking about these markets, right? We've talked about how viewing the markets from 3 different lenses, right? Fundamentals. We know valuations are high. Price to earnings right now are about 23, 24 times. That's historically high. But we also have to remember the market today is almost 50% made up of technology stocks, right? The tech sector is about 35, 36. If you included some of these companies that aren't technically in the technology sector, but are technology companies, right? Again, Amazon, Google, Meta, these big cap technology companies make up about 50% of the market. When you think about technology companies, their price is predicated about 2/3 of their price versus, value companies, which is about half. 2/3 of their price is based on their future earnings potential. So you're going to see higher valuations when technology companies make up more of our economy. You saw the impact of AI spending on our GDP. It's a huge element of both the markets and the economy. So that's not uncommon. I do think from a longer term perspective, when fundamentals are high, maybe there's less higher upside. But again, that's more of an intermediate and long-term market issue versus a short-term. I always use the example, right? Valuations were low when we had the financial crisis. We weren't, at high valuations like we saw in the tech bubble. Much different environment from a fundamental standpoint. So that alone, again, shouldn't dictate how we view the markets. Technicals, I wrote about it a little bit, between different sector correlations, and just some other areas, 50-day moving averages laying beneath the surface. We may see some short-term volatility in the immediate term. Again, it may or may not happen, but there is potential for that. Again, shouldn't scare us out of the markets. And then, the big one is human behavior, right? It's nearly impossible to judge, and that's where when you talk about bubbles of the past, usually those bubbles sort of die or are formed in this euphoric environment. And I would say right now we're in a very optimistic environment, but I wouldn't necessarily say it's euphoria. We talked a lot about the AI revolution continuing to propel the markets. As we move forward, I think it's going to create plenty of opportunities. But as we also looked at that circularity issue, it's going to create some risk. And we just have to be aware of that as we move forward. And as we saw the impact with the GDP chart, it is helping drive our overall economic growth right now in our country. And then lastly, earnings are justifying market prices, right? We haven't seen a huge outlier in terms of where the S&P is versus where earnings are. Earnings continue to climb. Again, we're having great earnings reports this week from financial institutions. That's a good thing, right? And when big banks are doing well, it's usually a good sign for the economy. And as I shared earlier, tech weightings will naturally keep these valuations higher than maybe what the historical norm was. And what's going to be key is that earnings continue to keep pace. So with that, again, thank you so much for joining us today. If you have any questions, we'll be posting this on our website. We'll be sending out a recording in the slide deck for any of these slides. If you have any questions for anything Paolo or myself went over today, please don't hesitate to give us a call. Or if just any topic or something we shared today, triggers you to want to reach out to your advisor, again, please reach out to us at any point. Again, thank you so much for joining us, and we'll see you soon.